Welcome back from the break. In recent years, South African markets have been significantly influenced by global geopolitical shifts, global conflicts, heightened US-China tensions, and the recent trade tussles stemming from the Trump administration's tariff policies have all contributed to increased market volatility and economic uncertainty. Well, I'm joined in studio by Allan Gray's Thalia Petousis and Rand Merchant Bank's Isaah Mhlanga to unpack the implications of all of this. To tell you a little bit about their credentials, Thalia is a portfolio manager at Allan Gray, who currently manages the money market portfolio, the bond portfolio, the Africa fixed interest portfolio, portions of the balanced fixed interest portfolios, and the income and interest funds. Isaah is the chief economist and head of global markets research at RMB and a member of the bank's Global Markets Exco. He leads research across macroeconomics, fixed income, currencies, commodities, and credit in South Africa and the rest of the continent. Thank you so much, both of you, for joining us.
Good to be here.
Good stuff. So let me first start with you, Thalia. So we have a situation where a lot has changed this year with Donald Trump having taken office for the second time in January. He's pulled the aid rug from many countries that have really relied on it. And on top of that, of course, he's decided to get tough with friend and foe in terms of his tariff policy. I just wanted to get a sense from you what you have observed to be the permutations of just those two policies alone, because, of course, there are a lot more policies that he's implemented.
Yeah, so it's a great question. I mean, we could probably spend the entire 45 minutes discussing just that. But really, the permutations in my mind have been the countries are scrambling. South Africa has been scrambling, in part, as you saliently point out, to fill this aid gap. So there's a lot of aid that's been dispersed historically by the US, some directly, some by the World Bank and IMF, so they're Bretton Woods institutions. While that aid has continued to be rolled out, a lot of the US direct aid has been suspended. And obviously that's coming at quite a difficult time. You know, highly impoverished countries across the continent, they're not in the best situation, you know, in that since COVID, a lot of their sovereign balance sheets haven't recovered. So they're running really large and wide fiscal deficits versus history. And now you have an extra hole in the budget that one has to fill as a result of this lost aid. So for us, that's obviously affected us in terms of our HIV program. National Treasury is trying to find room within our budget, and they've been in quite a precarious situation with regards to that budget regardless. And then over on the other side of the coin, on the trade side as well, people are now, you know, trying to fill the gap from potentially lost US exports, which is an extremely difficult thing to do. I would say in some realms, in some respects, almost impossible, since the US is the largest consumer in the world. But there's something else that really struck me that you said right in the beginning. You said things have changed very suddenly this year. And I actually want to challenge that slightly because in my mind, the change may seem sudden, but I see it that Donald Trump, or President Donald Trump, he's really the symptom of a larger shift that's been unfolding for more than a decade. And in my mind, you know, we've been in the last 45 or so odd years, since the end of the Cold War, we've been in this remarkable period of peacetime, well, relative peacetime versus history, and of free trade as a result of that. And that's really because the US has underwritten, they've underwritten peacetime via their strong involvement in NATO and all that funding that they've been providing to NATO. And ergo, that has then facilitated free passage of goods, you know, via the seas and safe passage of trade routes. So they've really underwritten both of those things. But predating Donald Trump, I would say since the Bush administration, we haven't had a US president that's actually interested in foreign policy. And some of that is because the US public has not been very interested. They've actually regarded the US's ventures into, you know, foreign countries, for example, Afghanistan, Iraq, and so on, quite negatively. And they've wanted to see the end of these forever wars. They've wanted to see troops being pulled back. And we've seen, you know, a slew of presidents not being very interested in foreign policy. So I think the US has for some time been having an existential crisis. Does it serve them to fund NATO, to underwrite global peacetime security? Does it serve them to underwrite free trade? Because what has it left them with? It's left them with very large twin deficits. So they've had this very large fiscal deficit, and some of this is all of this military spend they're doing. They've had this very large current account deficit because they're importing so many cheap goods from the rest of the world, primarily from China. And they've lost their export and manufacturing base because they can't really compete with China, who isn't following the same trade policies that they are. We're seeing, China's been essentially subsidizing the manufacturing sector. They haven't really had a very strict minimum wage in place for employees. The US can't adopt those sorts of practices, so they cannot compete. So how has it really served them? And I think they've been in this mode of existential crisis for a while, and Donald Trump is in a way a mouthpiece for all of these issues that have been building and that we've been discussing in financial markets for some time. The issue of, for example, the US twin deficits and their overspending and their lack of competitiveness in export markets.
Interesting perspective. So basically, Donald Trump is doing what perhaps others have thought about doing. There's a lot that Thalia has kind of outlined about the challenges, the backdrop and so on. But coming specifically to South Africa, obviously we have those 30% tariffs that were instituted last month. And this is obviously quite adverse for us. We're yet to see what the impact will be for South African exporters to the United States and, how the US market responds in terms of demand and so on and so forth. Government has stepped in. They've put forward some sort of export desk to try and advise people how to deal with the issue. And on top of that, they're talking about finding new markets. It's very simple to say, let's find new markets. And Thalia was saying that may well be impossible. I heard an example that, for example, Brazil, which has been levied with 50%, they had a conversation with China, and China said, don't worry about your coffee, bring it all to us. Now, that's an ideal scenario. In most instances, it's not going to work like that. So I just wanted to ask you, what sort of impacts do you think this is going to have for South Africa, and how must South African exporters deal with this particular situation?
Perhaps let me start where Thalia ended with the issues in the US. We see a couple of themes globally because it's so difficult to discern, or at least to take all this information and take out of it the implications of so what for our own economy. You are bombarded with so much information. So we have about 5 pillars that we think through almost everything that happens in the global economy. The first one, which Thalia spoke about, is the global fracturing and reorientation. Essentially, the trade dynamics that we have had since the Second World War starting to crumble, countries looking inward and not necessarily continue the globalization that have benefited the global economy for a very long time. And that fracturing happens across institutions, across trade and finance, and then the geopolitics where you have the 3 axes of the US, China on the other side, and then the so-called non-aligned. We have to position ourselves within that framework as a country. And then you have a longer-term theme of now higher inflation in future than what we have seen historically, at least over the last decade, which then bring the third one, which is structurally higher interest rate than what we have seen historically. And you can see, as of this past couple of weeks, US 30-year bond yields close to 5%. That is a red light. UK bond yields as well, close to 5%. That's a big red light. So that's theme of higher interest rate coming on the back of the large fiscal deficits, high debt levels. It means it's going to be far more difficult for these large economies to finance themselves.
And just to dumb it down a little bit, what is the significance of the higher yields that you're talking about?
If you have low economic growth, it means the ability to collect tax revenues is limited, which means you have to borrow in order to continue spending on things like defense, for instance, or spending on new manufacturing capacity, as the US seems to want to do. So high debt levels mean the increase in bond yields or interest costs takes a bigger share of the money that should be used either for spending on economic reforms. So it is quite important to watch those bond yields as they go up, because they take an increasing share of revenues that could be used for productive means. So it is a very concerning issue that we're watching. It simply says something will break at some point. If you don't have higher growth, you have high debt, you have increasing yields, something will break. So we just have to watch that. Now, how this comes back into our own economies, when you construct a risk-free rate in South Africa, at least in simple terms, at what level of interest rate does the country borrow? You always start from the US risk-free rate. That has gone up, which means even from our own perspective, that starting point is now higher. So it increases global costs of borrowing, which is stifling from an economic growth perspective. From a trade perspective, yes, we have to diversify. That's what the policymakers are thinking. But it takes a minimum of 5 years, in the best of scenarios, to negotiate a free trade agreement with another country. So it's not going to be possible to shift our export destinations quickly enough, which is why you are seeing announcement of job losses in the steel sector, in the automotive sector. But what we are doing in South Africa, other countries are also doing, including China. It's shifting its exports to other countries away from the US, and some of those exports land in our own country. Take, for instance, the automotive sector. I drove last night from the airport coming here. I couldn't recognize 3 cars that were on either side of me and one in front, because these are not traditional cars that we are used to in the country. These are imports. The implication is it's a displacement of local producers that have been employing people, and as those are displaced, people lose jobs. It's not just the automotive sector. We have to think about the manufacturing sector as a whole, where we are going to see a flood of imports into our country from the likes of China that will displace domestic producers. And as those domestic producers are displaced, it means people are going to lose jobs. So it will have a real consequence in terms of job losses and livelihoods in the country, which means we have to rethink how we open up our own economy, how we diversify, taking into account that other countries are also doing the same that might be negative for our own economy.
A lot of challenges that you're citing there, a higher interest rate environment, which is negative for South Africa because we want to invest in things like infrastructure. We need funding for that. You're talking about the loss of jobs because of the infiltration of, for example, Chinese cars and so on and so forth. So South Africa is part of the BRICS, and it's a small S in the BRICS. It's got the big guys there: China, India, Brazil. And the big question now, as we move to what they're terming a multipolar world, is how can South Africa position itself? Should it move more towards the East in trying to secure its economic future, or can it remain friends with the West in that way as well as the East? How does it go about doing things, especially because it really isn't at a negotiation level? It's not on the same level as China and India, for example, just as it isn't with the West?
Yeah, so that's a great question. Firstly, just tiny point of contention. Even though you could say we're small in the BRICS, we're just the S at the end, we did each have to contribute an equal amount to become shareholder. I forget what was it, $2 billion? I forget the amount. But yeah, so we had to pull our weight as much as the others. But yeah, it's a great question, and I guess Isaah has just unpacked. And this is my one concern around BRICS. I see it, and maybe you see it differently, as being more of an ideological union. But in terms of trade, I'm not clear how it benefits us, because one of the big powerhouses in it, China, is a big competitor to us in terms of trade. And I mean, we've just mentioned, in terms of our vehicle exports, I mean, now, especially with the high tariff they faced into the US market, this trend of them flooding, the rest of the world, and in particular South Africa, with their cheap automotive exports is just going to increase. And I mean, the pricing points of some of these Chinese cars is very attractive. I mean, I have colleagues who've, been looking at them and said, it's half the price of, the equivalent, luxury vehicle, that's manufactured out of SA. I mean, they also compete with us actually in clothing and textiles. So the Sheins and Temus of the world have been, competing with our local retailers, also at very aggressive pricing points.
Taking massive market share.
Taking massive market share. And I mean, this is part of the, I spoke to this earlier, this is part of, I actually see it that the crowning moment of globalization was in 2001 when China entered the World Trade Organization. But that was, but that was also, it was a crowning moment, but it also sowed the seeds of globalization's destruction. Because you had China coming in, you had their government subsidizing the manufacturing sector. You have, a country where people are, there's no real set minimum wage in my mind, in my opinion. It's just, other countries can't compete. I think Isaah also mentioned steel. That's also, our market's been flooded with cheap Chinese steel. ArcelorMittal has had to close their long steel business. A few thousand jobs, both directly and indirectly downstream, that are going to be affected by that. So I'm not clear that from a trade perspective, BRICS right now is offering us that much. One could question perhaps from a funding perspective, are there some opportunities? Yeah, there are some. So BRICS, the BRICS Bank, it now operates via New Development Bank. They've been funding some of our state-owned entities lately. You would have seen there was last year the big, I think they signed a deal with Transnet. I think they gave them somewhere in the quantum of 7 billion odd. They've signed something with Sanral to disperse funding. It's not necessarily at the ultra-low, cheap and concessional rates of funding that the IMF and World Bank will lend on to highly impoverished countries across the continent. So typically when the IMF comes in and let's say they fund a country like Uganda, they'll do it on average at interest rates as low as 2%. So way below your local in-country domestic borrowing cost. And often there'll be other very favourable terms. So they'll say, you have 5 years of grace on interest and so on. I will say, from coming from BRICS or New Development Bank, it hasn't struck me as being, ultra cheap. I think the funding they did last year with Transnet, the first coupon on that funding, it was a floating rate, was, I think it was about 13% interest rate. So it's not super cheap, but there could be some opportunities there. But yeah, I tend to see it as more of an ideological union, and I would prefer to see SA's foreign policy playing both sides, so not aligning oneself too strongly with BRICS countries at the expense of Western kind of world and the US, because as I mentioned right at the onset, the US is the biggest consumer in the world. They're responsible for, I don't know, maybe it's 30% to 40% of global consumption. So we cannot really replace all of that consumption with BRICS partners. China is predominantly, that they're a production and exporting powerhouse. Now, China has for a long time said that they have plans to stimulate domestic consumption. I'd say that's been a policy objective for a while. But that could take, a multi-year, even a multi-decade kind of period. And some of that is you'd have to see real wage growth in China increase. And I guess what's standing as a barrier to that is when you have an environment of overproduction, of subsidization, you have a lot of manufacturers in China with razor-thin profit margins. Some of them are actually, operate at a loss, but you get these government subsidies to keep you afloat. Now, in that kind of environment, you can't offer your workers very high real wage increases, which is why, in Tier 2 Chinese cities, so outside of Beijing and Shanghai, high, you've seen the standard of living not really increase. In fact, anecdotally, it seems like, certainly in certain kind of more rural areas, the standard of living has decreased. So that is then an impediment to consumption coming online, such that we could, envisage one day redoing a lot of trade deals, that we've predominantly exported into the US, into China. So I think at the moment we're looking at, let's say, the fruit export space, and we've signed some deals with China to try to export more stone fruit, and I think recently avocados as well. But yeah, I don't see right now BRICS as offering us some sort of salvation in terms of exports. On the contrary, I see it as a competitor, and I'd like to see us playing both sides a bit more in terms of our foreign policy, and also maybe a bit more of a cohesive foreign policy kind of narrative across multiple spheres of government. And because often it feels like one arm of government is, let's say, pledging allegiance with Iran, and then another arm of government tries to walk back those comments and do a bit of damage control. Because there's, economic ramifications to that if you alienate yourself from the West too much.
Maybe let me add there and provide a different perspective.
Yeah.
At least from what we read coming out of government, the policy seems to be unaligned. That's what government says. We have to differentiate what political parties say relative to what government officials say. From what we read, it seems government is pursuing a non-aligned policy. We had the president going to the US, the famous meeting with the US President Donald Trump, which was an attempt to re-improve trade relations between South Africa and the US. And we know that the National Treasury, the South African Reserve Bank, which are really the bureaucrats, they continue to have engagements and conversation on an ongoing basis. It seems to me that it is the political level that seems to be over-accentuated in terms of the development that takes place, but the bureaucratic level continues to engage in a much more constructive basis. Having said that, if we just look at the longer-term perspective, the UK was once a global power. It declined. Japan was once a global power. It also declined. If you take hundreds of years back, Spain was once a global power. It also declined. So this is not completely new. We have seen these trends over a long period of time where superpower comes, they rise, they peak, they start to fall. We're likely seeing the US starting to decline. Even when you look in terms of productivity, output per worker, it has declined. It's a consumer-driven economy. Productivity has declined. And then on the other side, you have China, whose productivity has been rising, in part aided by investments in technology, which is why we're seeing their cars everywhere. In the AI space, they are now almost rivaling the United States. Some of the products that come out of the US are assembled or even made in China, the iPhones and many, many others. That is, as anecdotes and examples of how productive the Chinese economy has been. And then if you look into the future, China is over 1 billion people. Relative to the US, that is 300 million people. The size of the market, the Chinese is much bigger, even though from an income perspective, the US still command the largest income.
Let me come in there. Because part of the Trump policy is not only to raise a lot of money through tariffs, but also to get companies, they've forced Apple to go into the United States and invest a lot more in terms of manufacturing capacity there. But you just raised the issue of the living standards. They're much higher because people get paid better.
Yeah.
Now, if you are going to set up shop in the United States, what is the cost of your production going to be? And are you going to have markets that will buy whatever you're making? Because surely it's going to be at a much higher cost than China, for example.
2 points on that. Tariffs are a tax on growth. And like a war, tariffs leaves no winners. Everybody loses out. ultimately it is the US consumers that are going to pay those higher tariffs. So it actually is a disservice to the country that is imposing tariffs on imports. The second one is with the levels of wages in the US relative to China, for instance, it becomes difficult from a cost perspective for companies to produce from the US because it's too expensive, which means you lose that competitiveness because your cost of production are much higher. That is the primary reason why most companies, they opted to manufacture out of China because wages were lower, which means profitability could be higher. That has been eroded over time as Chinese wages started to increase, which is where the African continent could be the next frontier of growth, because we still have high levels of unemployment, a youthful population, wages which are very low. That gives advantages in terms of relocating your production capacity from a cost perspective. We have a lot of these natural resources which enter into the production process. But for now, it seems if we just look at the US and China, productivity is far higher in China. We've also seen some relocation of production out of China into Mexico, into Venezuela, for instance, as a way to try and appease the US policy as it stands now.
And one of the things, before you intervene, Thalia, one of the things as well that I was reading about is that in China, for example, whilst they're less paid, their skill set is massive because they have become the manufacturing hub of the world. So as you shift production to the United States, you've got to build up all of that skill. And there's certain techniques and certain skill set that American people won't have, that they'd have to build up over time and so on.
So they'd have to build it up again. For example, the US has completely lost its shipbuilding capacity, so they cannot produce ships. And a lot of their workers have shifted into like financial and slightly more technically savvy roles. So you don't have, a strong industrial and manufacturing base at all. Maybe 1 or 2 points on what's been said now. I still do think, in order for China to transition to a large consumption-based economy, real wages will have to rise, and they will actually have to start producing at less competitive prices. Because, the profit margins of these companies, as I said, many of them are loss-making and they're subsidized by the state. Those profit margins would have to expand. You have to start offering, let's say vehicles at higher pricing points such that you can sustain higher real wages. I also think while that could be a long-term trend, this rise and fall of nations, I don't believe, it would be foolish to say the US will be, the world's superpower forever. These things can, play out over, decades-long periods. We might not be right at that tipping point yet. So I still think it would be wise for us to play it kind of on both sides of the fence. And then maybe also on that, I'm a bit concerned just with China. You overlay this. So, productivity has been very good, as you've said. They've developed a lot of manufacturing skills. Look at what they've done in synthetic diamonds, which is, it's been very interesting for an economy like Botswana. They can now produce a synthetic diamond, which is virtually indistinguishable from a natural mined diamond at a cost of, I was reading, a 3-carat diamond they can make for $15. I almost didn't believe it. That speaks to that manufacturing capability. But really, I've gone off on a tangent now. I'm very interested in. But really, this rise and fall of nations can take place over very long periods, and then overlaid in all of this, Chinese growth, I worry about declining population rates. And some of that, I think, is a throwback to the 1980s one-child policy. The population is set to decline. You mentioned it's such a large population. It's declining much faster than other nations. And, in the 1980s, they came up with this policy. And in fact, if you had a second child, you were forced to abort it, during your pregnancy. And I think it's left sort of permeated national psychology in the sense that people don't, they've been raised as a single child in a single child home, and they only expect to have one child, and they haven't been able to. They've run all these campaigns now trying to get people to have more children, and thus far it hasn't worked. So one has to also overlay. There's some other interesting macro factors that could put a stumbling block on, and China's ability to consume more, especially as you think if you're in an aging population, older people do not consume as much as younger people, or they don't consume goods as faster rate as younger people. They consume things like medical services, which maybe isn't so useful to us. We're not going to export medical services into the Chinese economy. But I completely take your point. We could be seeing a rise and fall of nations, and maybe that's being expressed in what's happened in the US dollar this year.
Yeah. Maybe the way that we can frame it in a way that is simple to decode the investment implications is to say advanced economies relative to emerging markets instead of China and the US. Let's broaden the how we look at these things. Emerging markets now command a bigger share of economic growth globally. From a population perspective, they still have higher birth rates, the point that you just mentioned now, which means if you're making long-term decisions that look into the future, you have to take a step back and say, where is my sources of growth and therefore returns going to come from? So you need to diversify within developed markets, but also look at emerging markets, because that is now an increasing force from an economic growth perspective. Look at growth rates in the US, in the UK, in Japan, in Germany, quite low, 1 to 2%. Emerging markets, 4% on average and up. Within the African continent, you could say 10 of the fastest 20 growing economies are in Africa. That tells you a change in the growth structure, which means it's also going to be a change in the sources of returns that investors have to look at. So diversify, not necessarily replacing the advanced economies. They still have a lot to offer, but look at the emerging markets as well, because in future they will become increasingly bigger drivers of returns.
That's an excellent point, and I just want to kind of build on that and bring it closer to home, to South Africa. Now, it's important for African nations to get their houses in order to take advantage of that future potential that you're talking about. And just looking at the South African context, we've got, Operation Vulindlela, we've got the reforms on the go, we've done quite well in the energy space. But the question I wanted to ask you is, how well are we really doing? And on top of that as well, we have great kind of plans to make South Africa a construction site and so on and so forth. But we have challenges, higher interest rates for development. We've got the construction mafia and these sorts of things where the government doesn't seem to have got a handle on ensuring that the environment is conducive for development. So I wanted to ask you, how are we doing, broadly speaking?
Yeah, so that is a great question. I'll just quickly address the last thing that Isaah said and just mention that in some ways you are talking our book, because via our offshore positioning and anyone who knows our offshore positioning mainly via Orbis, we have been running for a long time sort of a key kind of US underweight and quite very well diversified to elsewhere, other developed markets, emerging markets, etc. So echo those sentiments of not, the winners of the past are not necessarily going to be the winners of the future.
Absolutely.
So on the reforms, so I would say last year, following the formation of the GNU, there was a lot of optimism around reforms coming online very quickly. And there was over-enthusiasm. You can even see it if you look at kind of post the formation of the GNU, the kind of GDP projections for this year and next year, they were significantly higher than what we're realizing now. So I think people are realizing it's going to take longer than what they thought. These things don't change overnight. Maybe some of the green shoots, I would say. So, for example, in the last week or so, it's come out that Transnet has awarded 11 rail slots. They're not fully awarded. They still need to be fleshed out and, discussed, but along various rail corridors to private concessionaires, so, people like Grindrod and so on. Now, that's positive. We actually still need to engage with some of those players, but that doesn't mean it's going to happen overnight. So I think of the 11, the only who have spare capacity in terms of locomotives, I believe, is Grindrod. If you're going to order any locomotives to be built, there's like a 3 to 5 year lag time. Now, you might be able to lease some from Transnet's rolling stock, but we're waiting to hear how some of these private concessionaires feel about that. So there have been questions raised in the past about some of their rolling stock's quite old, they've had to have it fixed. It's not necessarily well suited to parts of the line.
Most of them don't even have train drivers,
Yeah. Yeah, well, so exactly. So, and then as you mentioned, things like corruption, theft of copper cable across the line. That's also so you'd also have to do a lot of infrastructure spend along those portions of the line that they want to be running. And specifically, they've been awarded for general freight, where we know the line has been eroded. It could be billions of rands of investment. Then, some of the concessions they've been offered, so it's not like, you can run on this line forever. So it's up to 10 years, but some, our understanding, is as short as 1 year. Now, that's a little bit concerning, just because if you're a private rail operator and you're being asked to invest millions of rands in locomotives, you're going to need a longer time frame than a year. So all of these details need to be fleshed out. A tariff needs to be agreed. At what tariff are you going to earn to run along this line? Is it economically viable, etc.? But I will say that there are green shoots. So there's momentum. I mean, this is a step in the right direction. It's more than we had a few years ago. So I don't want to be too negative, but I also I don't foresee super quick turnaround. So yeah, and then and Isaah, I'm sure you will have a lot to say on these various reform policy initiatives, but also something like energy reform. Why will it not be, a very quick turnaround? We've got to build out thousands of kilometers of transmission line. I think it's something like, 13,000 kilometers? In order for all of these renewable energy projects to plug into. Now, I think we've been building transmission lines, at sort of a rate of, 300 to 400 kilometers per annum. Granted, we haven't really tried, but we've lost some of those skills in order to actually build out these lines. So some of that, we've also seen construction sector kind of get decimated over a multi-year period as infrastructure spending really, fell off a cliff in some respects. So these aren't quick turnarounds, but certainly they are green shoots. I guess that would be my summary.
Yeah, maybe if I could add to that. I think there are the sort of near-term issues that seems to be quite negative, very slow growth, and then we have to cast our eyes medium to longer-term perspective if we're thinking about confidence in the economy and what it could do going forward. We have to admit last year globally has been the most historic election year, with over 50% of the populations going to vote. The outcomes of that has been a change in the setup of governments for 80% of the countries. So we are not unique from that perspective. We ended up with a GNU, which means there are some sort of checks and balances within the political system, even though it's volatile at times. But it means there is now a proper contestation of economic policy that actually influences the operating environment for many companies. Hopefully, that continues for the near future. Having said that, from a reform perspective, where are the green shoots? I haven't thought about load shedding in a long time. I haven't planned my life around when is load shedding happening. And that, I think, is a big development. Just not thinking about it, for corporates also not thinking about it, it means something positive has been done from an energy perspective. It's more stable. Yes, we are not there yet. Growth is still low, which means if growth picks up, we might have issues. But for now, I think that's a tick. If you think about the logistics reform that my colleague just mentioned now, we are at the beginning phases of seeing proper movement on logistics. If you then look at the water sector, you look at local government level, the intention, are these things going to happen? What level of confidence do we attach to the probability of implementation? And the way that we can look at it is wherever you have a convergence between political willingness and business support, then you have a policy that is likely to be implemented. A different way of looking at it is where the political costs of not doing a policy are too high, government is going to implement. And where the costs of business not participating in such a reforms is too high, business is going to support. We saw this in the telecommunication sector, the reform, the opening up of the sector to the private sector. With telecom, as an example of a company that was owned by government being privatized, no longer taking money out of the government coffers, but actually paying a dividend to the state.
Yeah.
We are now seeing the same in the electricity sector, where the private sector and government work hand in hand. The logistics sector, government and private sector will have to work hand in hand, in part because government does not have the capacity to run these big sectors by themselves, and they have misrun these sectors for a long time to the detriment of growth in the economy, but also in part because businesses are interrupted when there is no energy. They are interrupted when there is no proper logistics. So you have this convergence between government and business. So we can attach a higher level of probability in terms of our expectation that these reforms will be implemented. Timelines, that can take some time.
Yeah.
The electricity reforms took a very long time. We hope that the lessons out of the electricity reforms will be used in the reforms of the logistics and the water sector. So if you cast your eyes 3 years and beyond, we should have a higher level of confidence that we could get our economic growth above 3%. Modeling from the Bureau of Economic Research, also from the National Treasury, in terms of what is the level of growth that can come out of these reforms, indicate a minimum of 3%, which is a game changer from an employment perspective. So long-term, positive in terms of an outlook, much more confident in terms of that outlook. Short-term, we still have issues in part coming out of the elections, GNU, policies that are still quite uncertain, slowing down the investment cycle, which is not a South Africa-specific issue. It's also a global issue, which is why we're getting lower global growth this year. It's the result of the elections last year and the change in policies, some of which we are getting from the likes of the U.S. President Donald Trump. We also have ours, budgets not being passed in time, 3 iterations of the budgets, which means spending in government gets slowed down because you actually haven't passed the budget. So all of that contributes into a slower investment cycle. So that's what we're seeing over the short term.
It's certainly messy and complicated, but as Isaah says, we need to look beyond. But I think there's so many areas that we're not even going to get to cover. I mean, one of the issues or one of the elephants in the room is, the local government. We have very poor local government, and that is so important in terms of, boosting the economy, because that is where government intersects with business, with people, and so on and so forth. But I don't think we have time for that. And then as well, the issue of education. In order for us to be globally competitive and to generate a higher level of worker, so to speak, we need to go back to basics with our education system, because even though, a lot is allocated in terms of percentage by government towards that, somehow the outcomes are not that great. Another area which we could talk to at length, but I don't think we have time. But I wanted to ask you, Thalia, with everything that we've discussed, just barely scratching the surface, what then does this mean for people who are responsible for managing clients' money in terms of how they allocate funding at the moment, especially given that there is so much noise? How do they remain focused? What are the principles and guides that they need to use to, on the one hand, take in what's happening in the short term, but having an eye on the long term as well?
Yeah, so it's a great question. And I agree with you. We've barely scratched the surface. And I actually did want to interject on the local government, because I think that's going to be the big stumbling block, unfortunately,
Speak
for water.
For 1 minute, and then you can conclude.
I think it's my concern just with water reform is with Eskom, you could fix that chimney duct that collapsed, and you could open it up to private sector generation, and all these solar panels get installed and so on. Great. But the water sector, the whole water network is dispersed across hundreds of municipalities and so on. And there's been an erosion of skills at that level. So no longer have engineers being employed and so on. So that's my one concern. But I still do think, I'm not completely bearish, but it may be harder. But okay, just in terms of managing money, and I think we did discuss it, obviously diversification, not having all your eggs in one basket. I mentioned Isaah has very kindly spoken our book in terms of offshore positioning, and that we've had an underweight to the dollar. So let's say something like Liberation Day happens and there's all this geopolitical noise. I mean, definitely, one shouldn't panic, never panic. But I'm not an advocate for just buy the dip. So sometimes people say, just buy the dip, everything's fallen, because that assumes that, your winners in the past are always going to be your winners in the future. And we don't necessarily believe that. And where buy the dip wouldn't have helped you is the dollar derated enormously post-Liberation Day, and it has continued to sell off. So if you'd gone and then loaded up on dollars, actually you'd be in a worse position at that point in time. So also just to remain clear-headed and think about, okay, in particular, and I guess we were asked to discuss geopolitical noise, there could be an impact on trade. One has to think about long-term impacts and how things could play out over 10 to 15-year periods. So it may warrant some subtle reshifting in positioning based on new information. So I'm not an advocate for just wholesale buy the dip thinking. And then diversification and, potentially even the rise and fall of nations, as we discussed.
Indeed.
Yeah.
I think, as we discuss the rise and fall, we don't quite know when the fall's going to happen, but maybe we are at the cusp of it. But thank you so much, both of you, for speaking to us and giving us your insights. Up next, our final panel of the day will explore how the group risk insurance landscape has evolved significantly in recent years, influenced by both global events and local developments. The panel will explore these changes, looking into evolving claims experiences and benefit options. Manager in Group Savings and Investments at Allan Gray, Ilyas Khamit, will moderate the panel. Please give us a moment while we reset the studio for our next panel discussion.